Coming up on today's show, where we stand with earnings season for the Russell 2000, why these AI names are falling, and what it means for the future of AI, consumer sentiment, and the warnings we need to be aware of, and why more volatility is likely on the way. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks were mixed on Thursday in anticipation of Amazon's quarterly results, as well as investors assessing the overall earnings season so far and eyeing some fast-moving policy overhaul from President Donald Trump's White House. And what we saw today was a lot of green and a lot of red, a very bifurcated market. And you could just see this exemplifies what we saw here today. Nvidia up 2%, Apple pretty much flat, the rest of semis are down in a very big way. Look at AVGO, Qualcomm, AMD, RTX, all of hardware down. And that's really what we saw today. Google in the red, Microsoft in the green, Meta in the green, the rest of software in the red. A very bifurcated market, but there were some standouts. Financials were actually very, very green today. They led the rally today, and we did see some pretty big earnings moves. For example, Eli Lilly was up 3.25% despite very mixed earnings, but we'll talk about them a little later on. But all in all, we saw the mega caps mixed as well. Tesla down 2%, Amazon rallying slightly into its earnings after the bell. Microsoft gained, Meta gained, Oracle gained, Nvidia gained the most, but Apple was flat, AVGO was flat, which we should really include in these mega cap names. It's pretty crazy that that's $1 trillion company. It kind of looks like a blip on the radar when compared to some of these other names. However, we did see some pretty big losers as well today. Energy being the biggest loser, down nearly 2%, followed by healthcare, utilities, which were down 0.91 and 0.22%. We also did see technology and XLY down today, but really they were just flat, only down 0.05 and 0.22%. And then we did see stuff like materials and communication services roughly in that same vein. So, the big market, the big boys were roughly flat today. I think what we really saw today, apart from the earnings situation, was a lot of digestion in stuff like tech, comm services, and discretionary. And that digestion led to a mild rotation into stuff like financials and industrials out of stuff like energy as well, and maybe some healthcare names too. The market didn't really have a trend today. We had cyclicals, sensitives, and defensives gain, and we also had the same stocks lose as well, with the S&P 500 pretty much flat here today. Winners and losers, such goes the market. But what we really did see today was net inflows here in the NASDAQ 100. So, the big names actually did see net inflows, but we saw net outflows for some of the smaller names, with the S&P 500 being flat. All in all, large cap growth outperformed today, and that was largely just on the back of Nvidia up 2%, and then we saw large cap growth up 0.52%. But every other factor in size segment lost. Mid cap value, investors didn't want anything to do with that, as well as small cap growth. Both were down 1%, but we saw the other factor segments down, core, value in smalls, as well as growth and core in mid caps. They were down. Large cap core was actually flat, down 0.04%, ever so slight losses. And then we also did see a 0.25% loss here in large cap value. Now, looking at some of the market movers today, Scott Bessent, Trump's Treasury Secretary, relieved some pressure on the Fed, saying that Trump wants to bring down the 10-year Treasury yield to ease borrowing costs rather than push for lower interest rates. This is a Treasury Secretary that gets it. Lower Fed funds doesn't necessarily mean lower 10-year yields. We've actually seen that in real time as the Fed have cut, yields have risen. Now, there's a whole bunch of factors that come into that, but it's really good to see the Treasury Secretary saying stuff like this. He gets it. He's been in Wall Street, he's lived in the markets, he's breathed the markets, and this is definitely someone you want in your corner and someone you want to listen to. Now, data didn't really move the market as much as you would think. We pretty much got initial jobless claims, came in slightly hotter than expected, 219 versus the 213 consensus, a slight miss, a slight uptick in revisions, 1,000 additions to the previous number. But I would say this number is largely in line. Continuing claims came largely in line. earning, and it continues to signal a tight but cooling labor market. And then the other data was nothing of consequence, just a couple of Fed speakers. Now, looking at earnings, Ford reported fourth quarter earnings. They actually had a double beat. They beat revenue and earnings, but the company issued muted full year guidance, pointing to tariffs as a headwind. As a result, Ford was down nearly 7% today. Skyworks Solutions was down 24%. Crazy move. Now, its stock dropped after it said it was losing business with Apple to one of its competitors, which analysts believe to be Broadcom AVGO. Now, Skyworks makes chips used in Apple devices that are crucial for wireless communication. Apple accounts for 72% of its $1 billion in revenue in December, and 85% of that revenue was from Apple iPhone sales. So if Skyworks is losing market share to their competition, it's going to have a tangible effect on their bottom line. And this is why we saw Skyworks down 24%. Other AI stocks, ARM Holdings and Qualcomm, both fell about 4% as their quarterly results showed signs that the AI boom isn't yet driving a surge in demand for consumer devices powered by these companies' chips. Despite their above forecast quarterly earnings and revenue, investors signaled that they aren't overly patiently waiting to see if artificial intelligence will drive a new wave of demand for consumer devices that rely on their chips. In other words, Wall Street is saying, show me the money, and they haven't just yet, and that's why they're getting sold. Both stocks were down 4%, in excess of 4%, nearly 5% here for Qualcomm. Nonetheless, and then Eli Lilly was up 3% today. It reported fourth quarter results and actually beat on the top line and bottom line. It beat Wall Street's estimates. Now, this did send the stock higher, but there was a couple of concerning things. It did miss on GLP-1 sales. However, the market doesn't seem too concerned because the stock was of 3.24%. All in all, with all of the momentum and moves we saw today, we saw 2,500 advances, 3,600 decliners, and it was simply just a very mixed day with a slight deterioration of breadth. And then looking at market momentum, trends continue to remain intact. The 5-day and 20-day shorter term trends are intact. Medium term trends are intact. Longer term trends are intact as well. In other words, any pullbacks we do get, guys, any volatility we do get, any wild near-term sentiment shifts we do get, buy those dips. Now, the S&P 500 and the Nasdaq 100 are largely trading flatline, up ever so slightly, but the biggest losers today was the IWM and the RSP, both down 0.42 and 0.3% respectively. And then we saw the S&P 600 and the S&P 400 largely in between. A very mixed day, but definitely a propensity for larger cap stocks, larger cap names today. And we did see a uptick here in yields. That's why we did see some of the smaller names under pressure today. Yields did tick up across the board. The 2-year, 10-year and 30-year yield, the dollar was pretty much flat, gained ever so slightly. Bonds as a result fell, and because of higher yields, we did see commodities take it on the chin. Gold down 0.38%, silver down 0.15%, WTI down 1%, nat gas up 0.5 percentage point, and the S&P 500 continues to do what we thought it would, and that is pretty much we put in a low here at the gamma flip. We're in negative gamma for a little bit, and now we've just bought the dip, looking for higher highs, higher lows into the core wall, the 6100 area, looking to retake some of these highs, which would mean all-time highs for the S&P 500. Had you bought the dip right here at the start of the week, like I advised, you would have been up very big on your money. And today we're just seeing largely a day of digestion. After a move like this, which when you measure it from peak to trough to yesterday's close, that's a 2% move in the S&P 500. You're going to get a little bit of digestion, especially as we approach the core resistance. For those of you that don't know, this is the gamma flip. This is the core resistance, the core wall. This is the put support. Above here, we're in positive gamma, and dealers hedge their books by selling into strength, buying into weakness. Below, we're in negative gamma, and dealers selling to weakness, buying to strength. You get very elevated volatility, as you can see exemplified by this right here. And then in positive gamma, we just get very linear returns, as you can see, bar any like macro events that we got from the DeepSeek situation, as well as the tariff situation. So what you always want to do is either buy the gamma flip or buy in negative gamma, aiming for the core wall. It's exactly what we did this week, and that's why we are where we are right now. So we had a single day of digestion. I view this as largely positive. And yes, this is a doji candle, but you do have to look at the structure of the doji. We did see a big wick here at the bottom, indicating that bulls and buyers did step up as we got below yesterday's open. The buyers saw value, bought that value, and now they're up ever so slightly. However, we did see a little bit of contingent selling here at the top, but to be expected. Again, just a day of digestion, all things considered. Looking at the Nasdaq 100, very similar situation, a day of digestion as we make our way to the core resistance, the 21,915 or the 22,000 level. That is our target. What I really want to see the Nasdaq do is retake this high. I really want to see a push, maybe some consolidation here, then a push above, maybe some consolidation here, and then a push above. That's what I want to see. If we see the core resistance act as resistance and we actually pull back from these highs and don't break above, that is not going to be good. So we really need to make a move right now in these large cap names. And if we can do that, and break above these highs, we can then go target all-time highs. Otherwise, we're going to be looking at lower lows, 3 lower lows in a row. Could this be the high, a lower low right here, and then a lower low right here as well as here? Doesn't look too good for the Nasdaq 100, and then we should start looking at downside opportunities. So the Nasdaq 100 is in a very critical position. It needs to make a move, make it quickly, break above, continue the momentum upwards. Otherwise, there is some danger in the near term. And looking at the RTY, we are at the scene of the crime, the core resistance. We actually did break above ever so slightly, but the bears came in very, very strong, sold, and now we're actually below yesterday's close. Very interesting. We're actually lower than what we were yesterday, owing to the fact that this core resistance is a very, very strong resistance zone. So the bulls are going to need to put in the work to break above this. However, I can see that it's a very, very key resistance zone. We also used it as resistance right here. Just if we go ahead and break this zone, when we do, it's going to be a strong support zone and it's going to propel us onward and upward. So yes, if we go ahead, break this resistance zone, it's going to be a strong support zone. However, bears are not letting go of this level. They really like this level right here, and bulls got their work cut out for them. So the game plan is very, very simple. You either want to wait for a break above the 2300 area to target all-time highs here in the Russell 2000, or you want to wait for the move lower and then buy the gamma flip, or potentially buy the put support, looking for us again to go ahead and break this level. For the Nasdaq 100, you're just looking for us to move to the core resistance and then the core resistance to move up and for us to break it, targeting all-time highs. And the same is true with the S&P 500. We want to see these highs. Now the market is about 12 minutes away from actually closing, and we are seeing a little bit of momentum come into this market. Nasdaq 100 and the S&P 500 are moving in the right direction. The RSP and the IWM kind of just laying flat here. Now let's have a look at some other charts now. Looking at Bitcoin, they were up 0.44%, and again we just continue to see this digestion period here for Bitcoin. I think anything in the low 90,000s, you want to buy that. My long-term target or end of year target for Bitcoin is about 130,000, so I think you really just want to buy this very strong support zone. There is strong institutional buying at these lows right here. You have Saylor, all of the big banks, BlackRock, all of them are key buyers at this 90,000 level. So you do have strong institutional support right here. You want to buy that for the next move up. And again, guys, that is what Bitcoin does. If you actually just zoom out, you see periods of consolidation, right? Then a rip, period of consolidation, then a rip, period of consolidation, then we wait for the next rip. And I do think that's going to come, especially with the strong institutional support we have seen at these levels. Gold taking a bit of a breather after what felt like just like 2 months of very linear returns. And again, this is just the market, pricing in the inflation concerns from tariffs, as well as all of the economic data we're getting in right now, as well as yields just moving lower. This has had a big move up, but I think gold looking a little bit extended. If we are to pull back, let's say to the 2700 area, right here, use it as support, that would be a higher low, and then we can go ahead and make new all-time highs and target the 3000 area. That is my end of year target for gold. So yeah, if we do continue to see a little bit of a move lower here, similar to what we saw right here, maybe not as violent, but a move lower, we put in a higher low, have some consolidation, and then make the next move up to the 3000 mark. I wouldn't be surprised if we got that with regards to gold. And then let's actually look at the dollar and yields, and then we'll wrap it up. And then looking at the dollar, we continue to find support here at this 107 area. For us to break below this 107 area, it's going to have to come with materially lower yields. Yields affect the dollar, not the other way around. Now the 10-year yield is at a very critical point. We did break this very key zone. What I expect to see now is a move here. If we use it as resistance, do expect yields to continue to move lower. That should coincide with a lower dollar. That should be good for some of the smaller names, the RSP, the IWM, S&P 400, S&P 600, And that should coincide with bonds moving higher as well as general equities moving higher. So this is the next key zone to be used as resistance for us to move lower, or if we will continue higher. I think we're going to see the latter, where this 4.5% area is going to be a key resistance zone, and then we move lower from there to roughly right here, the 4.1% range. And again, that's really going to support equity valuations in the medium and short term. But guys, you know what to do with the S&P 500. We're aiming for the 6100 area. In the Nasdaq 100, it's the 22,000 area. For the RTY, we're in wait and see mode as to what happens next. My opinion still stands: buy any weakness, buy the dip. Diving into sentiment, this is the AAII sentiment survey, and the latest survey shows a sharp decline in investor sentiment, particularly from 3 weeks ago, but also most recently from last week into this week. We saw bullish sentiment tick down from 41% to 33.3%, and this shift reflects growing investor concerns in recent market developments, and also exacerbated by the big move here in bearish sentiment. China's DeepSeek AI breakthrough has rattled the tech sector, raising fears of increased AI competition, as well as what that means for chip makers. And at the same time, renewed tariff tensions have added uncertainty, fueling the sentiment we are seeing right now. It really goes to show that individual investors are not feeling too confident about the market, despite how resilient stocks and the broader market have been. However, guys, you have to understand the type of volatility we've seen lately is actually kind of normal. In fact, when you look at post-election years, this type of volatility is actually very normal, and what we could actually see is a massive pullback over the next couple of weeks, where we could actually find a bottom. More often than not, towards the end of February and the back half of February, we see quite a lot of volatility, but that's normally when we put in a low for the rest of the year, and we do move onward and upward. And then looking at February seasonality in the S&P 500, we do see quite a bit of price momentum to the upside, especially towards the middle of February, and then we actually put in a high, move lower. However, again, this right here should simply be an opportunity for us to get long for the rest of the year. And guys, through everything we've seen this year, volatility is simply the price we pay to invest. You do have to understand that in any given year, we get about 3% dips. We actually get about 5% dips, right? This is called a mild correction. And in a single year, we normally do see 10% correction. And then once every 2 years, we do get a 50% pullback. Now, a 10% pullback is called a correction. A 20% pullback is actually called a bear market. So it's been about 2.5 years since we've actually had one of these as well as one of these, and 10% corrections have been far and few in between. So do expect volatility. However, you do have to put everything into perspective, the fundamental perspective. Now, we've been looking at S&P 500 earnings, and today we're going to look at Russell 2000 earnings. And guys, look at that earnings growth for this quarter, 51%, huge. Earnings expectations into this quarter was for 44%. So we are seeing huge alpha, huge beats, mostly driven by the comm services sector, but we are seeing growth in every single sector in the Russell 2000 except in materials and energy. And I'm sure that if you exclude energy and you exclude materials, right, you're probably looking at like close to 70, maybe 80% growth. Very similar here with the revenue expectations. I mean, if you just remove energy from the revenue part, you're probably looking at anywhere from 8 to 9% in Russell 2000 earnings growth. You know, this index is heavily loaded with like small miners, junior miners, and they all tend to show up here, and they're all very unprofitable. However, what we are seeing is a pretty solid beat rate, 69% of companies beating analyst expectations. However, quite a lot below, 26% actually below analyst expectation. Very interesting when you look at that. So I would say that in the S&P 500, the earnings picture looks good, and so too in the Russell 2000. And this is going to drive the rally regardless of the volatility we get. And what else is going to help the rally is the macro. The macro is solid. Now, we did see a pullback here in the Fed's GDP now for Q1. We saw a move up to the 4% mark, or just shy of the 4% mark. We've seen a pullback back to the 2.9% range here. So this is probably where we should be. This was probably an anomaly. And the reason why we had a pullback had to do with the PMIs we got yesterday. It came in a little bit weaker than expected, but nothing to actually go ahead and break the macro narrative. Now, looking at the consumer, this is very interesting. Something we look at on this channel every single month. Costco's monthly sales results, and we saw this is comparable sales, right? Excluding impacts from changes in gasoline prices, foreign exchange, where follows, right? So we're looking at 9.8% growth for the 4 weeks, and then the 22 weeks leading up into the most recent month, 8.1% growth. The total company, if you include foreign exchange and gas prices, 7.5% and 6% respectively. That's total, including e-commerce, and the US seeing huge growth, but not the biggest growing geography. In fact, Canada International growing much more than the US. So very solid results. This points to the consumer remaining resilient, and we know that because consumer measures have been great. One of them was ADP employment, guys. Private employers added 183,000 jobs in the month of January. The market's expectation, analysts were penciling in about 150,000 into this print. So this bode really well for NFP. And there was actually the writing on the wall with regard to this. A couple of weeks ago, I showed you guys federal employment tax receipt looking extremely robust in the month of January, 11.3% growth. And this right here was signaling that we were going to get a good ADP number. And by extension, we're probably going to get a good non-farms number. At the very minimum, non-farms is going to meet expectations. So do be prepared for volatility, but based on the data we're seeing right now, this does set us up for probably a very resilient non-farm print. Now, looking at earnings for the rest of the week, the big names are behind us, guys. We've had a very crazy week of earnings, very volatile, particularly in the individual names, stuff like AMD, Google, Uber being very volatile, despite results being actually very good in my opinion. Now, tomorrow, Friday, we have Canopy Growth, and I think that's really it. We do have SIBO as well, Kimco Realty, not really major names reporting, but if you are in these individual stocks, do be aware they are, and earnings season is still underway. Now, let's actually talk about tomorrow. Tomorrow we get non-farms, okay, and the expectation, the consensus is for 170,000. Now, the forecast is for 205,000, but this is what analysts think we're going to do. This 205,000 number is what Trading Economics forecast based on all of their measures. You know, they're penciling in a better than expected number. And if we look at stuff like the ADP number and federal employment tax receipts, we probably are going to closer to this 200 level than we are to this. Although what I would say is expect a beat and maybe even some positive revisions here in the month of December. Now, the unemployment rate, the market expects it to be at the 4.1%, average hourly earnings to come in at 0.3, average hourly earnings year over year at 3.8%, the participation rate at 63.5%, and then the consumer sentiment gauge, UMISH, coming at 71.1, forecast for 72. So I think if we hit all of these numbers in line, the market should react positively to that. But if we do miss the non-farms numbers, I actually don't think it's going to be that bad. I think we see yields move lower, the dollar move lower, and I think you want to buy any volatility we do get, even if we do miss that number. The labor market has been really hot, and that should take some of the inflation angst off. However, more often than not, what we do want is a strong economy, and that starts with the strong labor market. So the stronger the number, the better. If we miss by a small margin, that's good. If we miss by anything more than a small margin, that can add a wrench into the works. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.